Good morning, guys. It is just after 25 past 8 on Tuesday, the 16th of May 2023. As you can probably hear, I've got a bit of a sore throat this morning, but we will persist nonetheless. So as you can see from a quick look at the blue and green lines here that I always refer to, the current price and the average price, there is not a lot between them. However, I think if we zoom out a little bit to about that point, what I would say about the state of the market as things stand at present is that if you look at the peaks and troughs, in other words the highs and the lows, I think they are reducing in amplitude. In other words, the lows are not so low and the highs are not so high, so basically it appears as though there may be some stability beginning to appear, which has to be a good thing if that's right. I mean, I suppose if I were to to try to show it as a trend, I would suggest that it runs something like this for the peaks, the troughs rather. I'm just trying to catch the sort of the bigger bit of the bottom of those red candles, something like that. As for the other aspect of this, the peaks, it's kind of difficult to really tell where to go with that, but I think I might be inclined to represent that something like this. So I'm just really trying to, I know I've missed that one there altogether, but I think that is an outlier. So I'm trying to catch basically the top of the larger part of the blue candles, here, another outlier, there and there, well, basically, as you can see, that is all kind of converging near enough towards our current price. No particular surprise there, but I suppose, if you were to look at the gradient of those two lines, I would argue that this the decreasing troughs appears to be slightly steeper than albeit decreasing peaks. So in other words, on the whole, I feel as though price is headed upwards. I'll take those off because I don't want those on there. But yeah, as I say, I feel as though price is generally headed upwards, and as we know, here is our sort of historical trend line, and as things stand, we are miles off that. In fact, I cannot even actually, I might be able to get it on the screen if I go, yeah. So if I change the look of things, I can just about show the gap between where I would have expected the current price to be, were all things equal, and the current reality. Just extrapolating that out a little bit. So hypothetically speaking, I would have thought that fair price about now should be in around £83. Had the market continued its previous trajectory, which obviously it has not, for a variety of reasons, most of which are external factors. So guys, just a quick look at the current state of play. So the market for today, as things stand, currently up 0.25%, up about 1.25% on the week, and honestly there's not an awful lot to be gained by looking back beyond that, because it's just the roller coaster that we're looking at. But in terms of our portfolio value, we are just in the green and no more than that. And as I say, I think there are reasons to be optimistic in the current climate. As we know, the majority of financial crises last on average 2 years or less. And in the year or two that follows, typically you can expect to see growth of anywhere between 15 and 30%, compared to the current value. So with that all said, let's have a quick look at notifications. So some information about biggest stocks before earnings. Good to see Rumble mentioned there. Rumble is a video platform, a competitor to YouTube, I suppose. And as anybody in the freedom movement will know, Rumble hosts a lot of content that would not be permitted on YouTube. So I'm very pleased to see Rumble mentioned there. I wasn't aware it was a publicly traded company. ASOS down 21%. I don't know if that's the same company as the computer manufacturer. It could be, it might not be. And there's a therapeutics company up 23% as the FDA panel nods in favour of gene therapy. Right, there it's here in blue and white. It says the FDA nods in favour of gene therapy. Guys, if you want to know about gene therapy, I suggest you go to Rumble and you do a search for gene therapy. And you might also want to include the letters mRNA in that search. Enough said about that before I get another warning. Right, let's get on and buy our weekly £120 worth of stock in the S&P 500. That's going to buy us roughly 1.91 shares. We hope. It's a market buy. The market is open, and that is going through now. We'll see it listed up here. The order is placed. Doesn't appear to have executed yet. There we go. I don't know why that took so long, given that this is the practice platform, but it's, you know, the money is theoretical. But anyway, yeah, it seemed to take a minute to go through there. Bane of my life, this thing on the right here, it hasn't updated. The new portfolio value you might be able to make out just down at the bottom here. It's 7,097 and currently 87p. we've got 42,920 free funds, and that is really all there is to say about that. This notification is just the purchase that we've just done there. So actually, where are we at? I was just wondering, where are we in terms of the actual shares? So here we are, here as you can see, just listed. In fact, this is probably incorrect now, since we've just purchased some more and it hasn't updated, but we've got 111, so I believe we've probably now got 113 actually after that 1.9. So 113 shares at £62 each. I was thinking earlier that it might be interesting to just do a quick look at figures for fire. Now I'm just thinking out loud. I don't know if this is going to work very well if I do this, but I'll try and see if it will let me, or if you can see what I see, so to speak. Bear with me, guys, just a second. Okay, I think what I'm going to do is I'm going to open a calculator in a new tab. There we go. Lovely. Okay. So, a couple of figures I would like you to try to get to grips with. And they relate to what is your financial independence number. And basically, guys, the guy that had developed the mathematics around all this is a guy by the name of William Bengen. He actually produced a paper which I'm just wondering if I can call that up. Let me just have a quick look-see. Okay, hopefully this so what I've looked up here is soft.uk.free.fr, which is the web page that goes along with the YouTube channel, and in here there are some resources. Okay, so we've got Get Into Grips with Finances, Firearm Ban 2, Hacking Fire, why your rate of investment is more important than how much you earn, Afloat, you might, well, I was going to say you might call the float the emergency fund. It's basically, yes, I started out calling it a float. I ended up, well, it's still a float in essence, but I had enough in it to kind of use it as an emergency fund, which was useful. Okay, I need to update this because it's clear to me that I do not currently have the PDF in here by William Bengen, as far as I can see, and I think that PDF is crucial. Let me just actually look it up. I think it's financial planning probably would be the title. Yes, it's something to do with determining the safe withdrawal rate. Let me just open this and see if that will be the right one. Oh dear, that's not it. Okay, sorry about that, folks. Most likely this one then. Now this does not look like the document that I had previously seen. Although I think it is probably using the same data. Guys, I'll tell you what I'll do. I will update the website whenever I find this document that I'm looking for. I would encourage you to have a read through, even print it out by all means. So it's William Bengen. It is the safe withdrawal rate. Actually, I think maybe the title. Yeah, I think it's worth having a look through this document. And again, I have not found the right one. But basically, the key thing is that the safe withdrawal rate, calculated over a length of time, is around about 4% per annum. And by using that, I think this is me here actually. By using the safe withdrawal rate, that's it. That's the document I'm looking for. Yeah, by using the safe withdrawal rate, and depending on your assets allocation. So William Bengen looked at a mixture of stocks and bonds. And from memory, the allocation that gave the best or the most reliable return over a 30-year period was a roughly 60-40 split. In favor of stocks. So in other words, if you were to sort of combine the knowledge here with the knowledge that is in the Simple Path to Wealth by J.L. Collins, you would end up probably buying a 60-40 allocation of stocks, and then on the other hand of that, 40% bonds. And as I say, then that has been shown to be a reliable portfolio for financial independence lasting for at least 30 years in the vast majority of cases. It's something like, I don't know the exact percent, but it's in the high 90s anyway. It'll be in the document. Okay, so a couple of key figures. What I want to get across to you in terms of what your FIRE number should be, and it all revolves around this 4% notion. Okay, so William Bengen calculated that the amount of money that you need to have in your portfolio to be able to call yourself financially independent is 25 times your annual expenses. Okay, so it's not 25 times your salary, or at least hopefully it's not, because if it is, you're in trouble. But it's 25 times your annual expenses. Now, as you know, 4 times 25 is 100, and I think it's that relationship, it's the fact that it's 4%. That's how you end up with the sort of the 25 times multiple. So let's say, for instance, if your annual expenses were £12,000 a year, which I think would put you, in terms of income, I think that would put you just below the income tax threshold. So if you wanted to work out how much money you would need invested to count yourself as financially independent with that sort of expenditure, you multiply that by 25 years and you come up with a figure of £300,000. Now, the other thing, of course, to appreciate is that as investments go, normally, on average, the S&P 500 delivers a slightly better than 10% growth per year, and that is compounded over time. So in fact, to get to 300,000 is not as much of an issue as what it might first seem. There's another way to look at to basically to arrive at this figure, I suppose. So here I looked at your annual expenditure. So as I say, if your annual expenditure was 12,000, you would arrive at that number. The other way to do it is to look at your monthly expenditure. So if your monthly expenditure was 1,000, so it's taking the same amount, 12,000 annually, 1,000 monthly, and if you want to work out monthly how much you need in order to be able to declare FIRE, you take your monthly expenditure and multiply by 300, folks. So it's 300 monthly, which gives you your 300,000, of course, or 25 times your annual expenditure. Now, the reason I like this monthly figure is that before you get to FIRE, say you're looking at your portfolio, and like in our current example, I mean, we've got a portfolio value of almost £7,100. Okay. So let's say you were wanting to know what amount of money could actually, sorry, I am talking nonsense. Well, yeah, I am and I'm not. Okay, so the current portfolio value 7,100, right? So if you want to know basically what that portfolio value would essentially buy you in terms of financial independence, you can simply to get an annual figure, you can divide by 25, or to get a monthly figure, you can divide by 300. Now, it's not going to be an awful lot, but bear in mind we've not been doing it for very long. There's been no significant growth in the market since we have started, as compared to the initial value, and that so currently speaking, at that portfolio value, hypothetically, could probably fund a, I don't know, what would you call that, a mobile phone contract per month, £23.60, at a withdrawal rate of 4%, and that would be good for 30 plus years. You can do it the other way. Let's say you're like me. Let's say your mobile phone contract is between £6 and £7. I don't remember the exact figure. It went up a bit because of VAT or something. Actually, no, it wasn't VAT. I think they just put the price up in April. Anyhow, let's say it was £7 a month. If you wanted to know how much money you would need invested to be able to fire £7 a month, multiply by 300, 2,100 invested would essentially pay for your mobile phone contract per month. If you withdrew £7 a month at a 4%, so that's a 4% withdrawal rate. We can demonstrate that. So 4% of 2,100 is 0.04. So that's £84. That's per year. Divide that by 12, we're going to get 7. There you go. So yeah, as I say, guys, I think it's good to know the mathematics around FIRE. It's sometimes interesting just to say to yourself, how much would I need invested to I don't know, to fund. Let's say, for instance, here's an example, and it's probably actually a good example, because personally speaking, although I am looking to finish work at age, 57, I will not be able to take any pension before age 60 without a penalty, and once I reach age 60, the amount of pension that will be available to me hypothetically wouldn't be sufficient to live off. Now I will be getting more pension coming payable at age 67, both work pension and state pension, but and I can access the other part of the work pension early, but at a penalty if I choose to do that. So let's say, for argument's sake, that I needed, well, let's just take the 12,000. Let's say I needed 12,000 per year to live on. 12,000 in income. Let's say I was receiving 3,000 per year at age 60. So that would mean that I would have a remaining 9,000 not not being paid to me, so that would need to come from my portfolio. So in order to fund that 9,000, I know that if I multiply by 25, that will tell me how much I would need to have invested. to be able to fund that. And there we go, 225,000 thereabouts, give or take. That's by the 4% rule. So as I say, if depending on your personal circumstances, you may find that it is useful or worthwhile to to forecast into the future a little bit, to actually work out what your expenditure is likely to need to be in the future, taking account of other income that you expect to have available at that time, and theoretically you can reduce your fire number accordingly. Obviously, whenever I first did that calculation there, I was using 12,000. For 12,000 you needed 300,000 invested. For 9,000 it's quite a bit less. It's almost 2/3 of that. 225,000. So it's worth playing around with the figures to see what's available, what's realistic for you, and whether well, I suppose if you're if you're really suited to fire by this method, and I suppose what I'm thinking on whenever I say that is that personally I am 46 currently, due to be 47 soon. I am aiming at a 10-year target, albeit I've already got some money invested. But it would be untrue to say that I am anywhere close to my target as things stand. And you may it really all does depend on the the rate that you can afford to invest at. I would suggest if you're 50 or older, my suggestion is that I would have my doubts about whether you can really regard fire through investing in the stock market as being a viable option. There's not to say that you can't, but unless you are able to throw a lot of money into your investments, there is an argument to be had about whether it's really worthwhile. Because at the end of the day, your time frame to declaring yourself retired is maybe rather short, and you could make the case that you might be just as well to put money into an ISA account with a good interest rate, and it does seem as though at the current time that there are some ISAs out there that are offering a good rate of return, and if you can do that for a few years, and the interest compound on that, then what I would suggest is that you may well be able to build up what is essentially a savings pot, and that obviously, if you're able to build up several years worth of a savings pot, well then you can choose to use that to your advantage. If you choose to stop working a few years early, you can rely on the savings pot that you've built up. As we know, savings is not subject to the same volatility as the stock market is, and from that point of view, it's possibly an option. Now, there is a caveat to this, and also to the sort of fire that I mentioned, where you take into account any kind of a pension that you might hope to get in the future. And the caveat is that if you cease work and you cease contributing to your pension pot, well then, as you might expect, you will get less back in return than if you had continued working right up to retirement age, state retirement age. And for some people, maybe the right way is just to continue working. There are people that seem to enjoy their work well enough to make that a reality. I suppose again, it all depends on personal circumstances. If you've got kids, if you've got grandkids coming, if you're physically able, if you enjoy the work that you do, etc., etc., etc. So yeah, as I say, if you were 50 or over, I would really, I would have serious doubts about whether it is worth starting down a FIRE journey where you're making use of investments. Now, as I say, I do feel as though we are currently looking at some green shoots, and I do expect the market to jump somewhere between 15 and 30% in the next 12 months or so. But there are no guarantees, and if you want certainty, then investments is not the way to go. On the other hand, if you're younger, if you're in your 20s and you're just starting out, absolutely get into investing, particularly into something like the S&P 500. Go and spend the tenner to buy J.L. Collins' book, The Simple Path to Wealth. What I will say about J.L. Collins is that he does not keep secrets. All the information that is in his book is freely available online, to the best of my knowledge. And it's the book is just simply a nice way to have the information all together in one spot. But yeah, if you're in your 20s or 30s, get investing. Put as much money as you can, as early as you can, into your investment portfolio. But obviously, don't leave yourself short. Make sure you have a rainy day fund and or an emergency fund for anything that you're going to need to pay for, and anything above that, throw it into investments, because the value that you've got if you're in your 20s or 30s is time. You've got time for the market to work its magic on your investments, and if you think about it, if you can achieve a 10 or slightly better percentage return on average per year over the course of the next 20, 25, 30 years, you could, if you are able to put enough money in early and continue to do that consistently, you could retire in your 40s quite comfortably off. If let's say if you were able to build a investment portfolio worth £1 million, well, that would provide a potential income of £40,000 per year. Now, I should point out the fact that if you are drawing 40,000 in income per year, you will be over the threshold for income tax, and you will need to pay your income tax on that. So it may well be worth consulting a financial advisor. But as you might say, it's a nice problem to have. But yeah, don't leave that to chance. If that's your situation, make sure you do consult a financial advisor, guys. With all that said, I realise I have been talking on for quite a while. It wasn't the intention, but I'm passionate about the subject, so if you like the content, please feel free to give the video a like, hit subscribe. As I say, I will update the site and add in information on the safe withdrawal rate. All that remains is for me to thank you for watching and wish you a good end to your day. Thanks, guys.